Hello, my name is Jody Samuels, and I'd like to thank you for being here today, listening to this video so that I can speak to you about a topic that I am so ever passionate about. I'm going to teach you some very valuable skills that you can use to navigate and conquer the Forex markets, and any market for that matter, for maximum profit. The topic today is how Elliott wave analysis explains market movements, and that includes any type of market movement, whether you're trading Forex or stocks or commodities. So hopefully after the package of videos, you will be able to go back and begin using this information in your very own trading. This disclaimer is important for you to read. I'd like to tell you a little bit about myself before we begin, and I'm going to do that by way of illustration. I traded as a currency trader with JP Morgan for 14 years. I spent the first half of my career trading the British pound in the interbank market from 240 down to 105 and back up again to 160. I was the only female British pound trader for a major bank at the time, and it was really an old boys network with a few girls floating around, and it was during this time that I developed my passion for riding roller coasters. That's a joke, and it doesn't get any better than that. Seriously. At the bank we had several technical analysts who used Elliott wave analysis in their daily analysis for the traders on the desk. So when I left the bank and began trading my own account, that was when I really mastered Elliott wave analysis, because I didn't have an analyst sitting next to me all day long. I had to do it myself, and I did, and so can you. So today, when not trading for myself, my time is spent coaching and mentoring. And trading is my passion. So today, I hope to whet your Elliott wave appetites and pass on some of my passion for trading. How many of you feel like these two traders after a day's trading? On the left, we have stressed out Farah, bug-eyed and all. She literally slugged it out all day long in the markets, buying tops and selling bottoms. At the end of the day, she had nothing to show for it. In fact, she lost money. On the right, we have frustrated Fred, who also spent hours looking for setups in the market, chasing his tail all day long. At the end of the day, he broke even, exhausted and beaten. How do you feel when you slug it out all day long? Wasting a lot of time and don't reach your daily goal after working so hard. Wouldn't you like to feel like these two traders after a day's trading work? Successful Steve on the left, he had a great 3 hours trading the New York market and took the rest of the day off to relax by the pool. He planned his trade and traded his plan using one of the key Elliott wave trading setups that I'm going to teach you in one of the subsequent videos. While Confident Sally had the run of the markets today, and that's her playground. She gets rewarded now because she made her pip goal and stopped trading to play. So what you're going to be learning today in this session are a few important skills to supplement your current trading strategy and build trading confidence. Once you learn these skills, you will have a good idea of where to enter a trade and where to exit it, and you will spend less time getting caught up in the emotional frenzy of the market by buying tops and selling bottoms, and you will hopefully waste less time and money. See, it's really important to understand the rhythm of the market that you're trading so that it almost becomes intuitive to you to recognize patterns. So by understanding the way the market moves, the market cycles, you in effect will be understanding your strategy that much better. So I would say that Elliott wave analysis should be a complement to what you're already doing. And as they say, if it ain't broke, don't fix it. So this can be an add-on, just an overlay to what you're already doing. So again, what are the goals? To help you develop confidence as a trader by showing you how to read the market map. And that requires understanding which market cycle we are in. Did you know, for example, that roughly 30% of the time we are in trend markets and the rest of the time we are in sideways consolidations? That means that you can spend your time preparing for those lucrative trend moves and stay out of trouble during sideways markets, or you can learn how to trade those sideways markets, which, by the way, show up as trends in the smaller time frames. Sound a little confusing? Well, we will clarify that for you in short order. So what is the second goal? To help you make more money and save time and effort in order to reach your full potential as a trader. And the tool that we use is Elliott wave analysis. For today, in video number 1, we're going to learn a few things. We're going to talk about how market movements follow repetitive rhythms or waves, that each wave has a distinct personality, and then we're going to look at a case study looking at 5-wave impulsive patterns, including the current EURUSD wave count. Well, who was Ralph Nelson Elliott? Well, this guy really discovered something exciting. While he was ill with a virus and bedridden, he studied thousands upon thousands of stock charts over a 75-year period. And if you think that's impressive, remember, this was done before computers existed. Now that's impressive. And what he discovered is that markets move in cycles as a result of mass human behavior, and that the cycles follow patterns that obey rules. And here's the good part. Once you understand Elliott wave theory, you can, with a reasonable degree of accuracy, predict where the market is going. Now, who's beginning to pick up on my enthusiasm? Are you beginning to get a little bit more excited? Now, even though Ralph Nelson Elliott studied stock market data, by the way, his theories apply to any tradable market, including Forex and futures. Now, what we see here is the Elliott wave principle. This is a book that I've studied, written by Frost and Prechter. So this is a book that should probably be in your library if you are planning to really learn the Elliott wave principle. Let's talk about the science of chaos. Science of chaos talks about complex shapes that look the same at different orders of magnitude. And we normally think of these complex shapes when we think about nature, occurrences in nature. So from the clouds of the sky to the branches of a tree, to even cauliflowers and broccolis. And what we're getting at is the definition of a fractal. Okay? Fractals are self-similar patterns composed of smaller copies of themselves ad infinitum. So, too, the market that we're trading in is fractal in nature, where you see patterns in different time frames that show up in every single time frame that you're looking at on your chart. And this is exactly what Elliott stumbled upon. He stumbled upon a fractal in the markets. So let's look at that. From the wave principle, the Elliott wave sequence, Fibonacci sequence, tied collective human behavior patterns to the golden sequence. Now, I appreciate that this slide looks complex, but it is simply to demonstrate the repetitive or fractal nature of market movements. As you can see, this is a complete market cycle with a trend move up, followed by a corrective move down. That's what it is. But when you look inside the market cycle, when you look inside the waves at its substructure, you see the same patterns emerging. You see sequences moving up for the impulse or the trend move, and then the corrections moving back down again. So this is an uptrend, and the reverse would be the market movements in a downtrend. All of this is based on the Fibonacci sequence, which we are going to lay out for you in the next video. And the Fibonacci sequence is a series of numbers, and you can see the series below the wave structures here. So what we're going to focus on today is how to understand the impulse moves or the motive waves versus the corrective waves. We want you to get the understanding of how the market moves and what this cycle is all about. But this is the basic structure of the Elliott wave cycle. 5 waves up and 3 waves down in the case of an uptrend, and the opposite is true as well. 5 waves down and 3 waves up for the correction. In this diagram, we see the breakdown of these moves of the wave pattern. So the top pattern shows the complete market cycle of 5 waves up and 3 waves down. So 5 waves up is the impulse or the trend, and 3 waves down is the correction. Now, if we think of this by time frames, let's imagine that the top 5 up and 3 down occurs on the daily chart. And then if you move down to a smaller time frame, let's say you're a swing trader and you trade the hourly chart, certainly by looking at the hourly chart, you're going to see the patterns broken down. So no longer do you see 5 waves up and 3 waves down in the daily picture, but you see many more 5 waves up and 3 waves down patterns. So as a swing trader, you would look at a smaller time frame to break down the market moves, and that would give you different entry levels, okay, different prices in which to enter your position. If we look at the graph at the bottom, you see that the wave structure is broken down further, and these are called subdegrees, lower and lower subdegrees. So imagine that the bottom graph is for a scalper. Maybe it's a 5-minute or a 1-minute chart, and you're looking at smaller and smaller time frames to be able to get in, to see the same patterns over and over again, to be able to get in at better levels in the market. Let's look at the market cycle broken down. Look at the top chart. You see 5 waves up for an uptrend and a 3-wave ABC correction. Well, imagine this is the daily chart. On the daily chart, imagine that you want to take a position long after the corrective wave 2. So you know your stop loss is going to be larger than if you take a position on a 5-minute chart as a day trader or a 15-minute chart. So you take your position, but you're still looking for that 5-wave structure, that impulsive pattern to play out when you're holding your position. Looking at the middle chart, let's imagine that that is for swing traders trading off of the hourly. So you see that you have the same entry points in terms of pattern of the cycle. You can still get in at the bottom of a wave 2 for a wave 3 higher. However, you have many different opportunities to do that because you see the same patterns occurring many times during the overall cycle. And if you look at the bottom chart, let's say you're a day trader and you're trading off of the 5-minute chart. Well, here again, you see lots of opportunities for entry. You're seeing the same patterns over and over again, just on different time frames. So if you begin to internalize these wave patterns, the cycles, no matter what time frame you're trading, you'll be able to take advantage of these market moves. So just understand that the Forex markets and every other market is fractal in nature, and once you understand and internalize these wave patterns and this structure, you will be able to apply it to any time frame and any market that you are trading. Let's look at an example on the next slide. In this example, I don't show it labeled. We don't know if it's a currency pair or a stock. We don't know that. And we also don't know what time frame it is. So again, these market movements reflect mass human psychology, and these movements form patterns that predict market behavior. And the fractal nature of the markets means that patterns repeat themselves in different time frames. So can you recognize the time frame of this chart? Is it a 5-minute, 15-minute, an hourly, daily, weekly, or monthly chart? Well, it happens to be the EURUSD, and it happens to be a weekly chart. But it could just as easily have been the S&P or a Euro 5-minute chart. Again, these patterns repeat themselves. They're fractal in nature. If we understand the cycles, if we understand the way the market moves, then we will understand when to enter the market and when to stay out of the market. That is the key. We want to be entering the market during a trend move. We want to be sitting and waiting during the sideways market. So we just talked about the basic wave patterns, and this is the impulsive structure, the 5-wave moves up that we spoke about. So the basic 5-wave structure in a rising market or an uptrend is called an impulsive or a motive move. And it consists of 3 upward movements separated by 2 downward movements. The corrective moves, or the downward moves, move against the predominant trend. And the 1, 3, and 5 waves move with the predominant trend. So what does that mean for your trading? It means that if you're trading the trend, you want to get in on the 2 or the 4 to ride the trend moves. And not until we have the 5-wave sequence should you even contemplate going short the market and going against the trend for the correction. It's best to stay with the trend. It's best to, especially if you're a swing trader and you're looking to capture slices of the move. If you're a scalper, I suppose you could scalp both ways, but still, it's much easier going with the grain than against the grain. The corrective structure is as follows. After you have the 5-wave move up in the impulse pattern, you have a basic 3-wave corrective structure consisting of 2 downward movements that are separated by 1 upward movement. Let's look at some examples. This is a chart of the EURUSD. It's a 15-minute uptrend. You can see a complete 5-wave cycle followed by a 3-wave correction. So this is the complete cycle, 5 waves up and 3 waves down. And this is a very nice impulsive move higher followed by a corrective sequence down. So this video number 1 is really just to understand these market movements, and then in subsequent videos we're going to talk about how to trade them. Okay, but first we need to understand them before we can even contemplate trading them. So just try to get in with the rhythm of the market as you're going through this presentation. Now what I've done here is the chart that we saw on the previous page is the 15-minute EURUSD, and that's in the small box in the middle. And I've put up a 5-minute EURUSD so that you could see the wave structure broken down even further. Again, if you're trading as a day trader and you want to move down to a smaller time frame, then you see the wave, you see further definition of the wave patterns. When you are trading and you are looking at 2 different time frames, the bigger time frame is to get perspective, is to gain context as to what's going on in the market, to see what the trend is, the bigger trend, and then you typically go down to a smaller time frame for trade entry, or for trade exit for that matter. So that's what we've done here. By going down to the 5-minute EURUSD, it might give you a better entry level, a better entry price. The smaller the time frame that you go down to, the smaller the stop loss that you will have. Okay, so it's quite possible for you to even start looking at the daily just to get the context, to see what the overall trend is, and then move down to the smaller time frames to get better entry levels. That's very, very common, because the bigger the time frame that you're trading off of, the bigger the stop loss. Now, you're also looking for a bigger profit objective when you're trading on the bigger time frame. So, really you have to figure out what type of trader you are, and that's really a function of your personality and a function of your time as well. Because if you have a full-time job, you're not going to be day trading. If you have a full-time job, you're going to be swing trading. You're probably going to be coming home after a day's work, and you're going to look at the markets for an hour, and take positions. You're going to be really a position taker, looking at the daily and the 4-hour and maybe the hourly chart to take your positions off of. So no matter what type of trader we are, we can always look at a smaller time frame to get a better entry level. If you're a day trader, you might be looking at the hourly chart for perspective and then going down to the 15 and the 5-minute or even the 1-minute for trade entry. If you're a momentum trader, you for sure are going to be looking at the 1-minute to take trades. Here's another example. This is the Euro Pound. This is a 4-hour chart, a downtrend as you can see. You can see the 5-wave impulsive move down with the 3-wave correction. And what you've seen me do on this chart is to run the Fibonacci tool on the 5-wave sequence to see what type of correction we might achieve. And we achieved a 38.2% correction. There's a typo there. So we've achieved a 38.2% correction in the ABC correction, and that is that's a typical correction. The corrections range from 38.2% to 61.8%, more or less. So that's the Euro Pound chart, 4-hour chart. But it really doesn't matter that it's a 4-hour chart, does it? I mean, again, since the markets are fractal, this could be a gold chart for all that, gold chart or an S&P or a particular stock or a different time frame. It can be a 5-minute, an hourly, a daily, a weekly. You get the point. Learn the patterns, internalize them, and then use them in your trading. Now we're going to talk about the distinct personality of each wave. So we understand the basic structure. For an uptrend, we have 5 waves up and 3 waves down. For a downtrend, we have 5 waves down and 3 waves up. Now let's understand that each wave has a distinct personality and better internalize these waves. When we start off a move, we call that point 0, and eventually after a 5-wave sequence we're getting to point T, or the termination point. So when we start off, we're at the market bottom. The traders are less emotional and ambivalent because the market is still bearish at this point. Don't forget, we've just come down. Prior to this point 0, we've had a down move. So no change in trend is evident. So I would say traders are still looking, for levels to sell, not recognizing that the market has turned around. Now, once you learn, Elliott wave analysis, you learn how to find the end of the trend and you learn how to find point 0. So you will be better equipped to taking positions really before the rest of the market does. But in this wave 1, it's going to appear like a sluggish move up because traders are indifferent, they're complacent, they're waiting for new clues as to the next move, which they think will be down again. So wave 1 moves up in 5 ways, and then we have wave 2. And we just described how the market traders are bearish, so they sell wave 2s. And that's why wave 2 moves are usually sharp, thus correcting most of wave 1. And that's where we typically see our double bottoms, where the market is still looking to sell. They'll sell a wave 2, and price doesn't go below the point 0 or the start of wave 1, and then it shoots up from there in a wave 3. So the characteristic of a wave 2 is that it is a sharp move down, correcting most of wave 1. Now, let's talk about wave 3. Wave 3 is your powerful uptrend. It's really an emotional thrust, most often the longest and the strongest. That's where the slope is the greatest in a wave 3, and this is also the greatest for profit potential. So Robert Prechter calls it a wonder to behold. And during this trend period, it's driven by confidence, especially in the stock market. and traders can make the most money here. It's like throwing a dart at a target. It's impossible to miss. Okay? Now, if a trader gets in too late, that's another story. So there are many opportunities to get in a wave 3, but you need to look for signals or signs that it is running out of steam, because you don't want to get in long at the top of a wave 3 and have to wait for a wave 4 corrective move. I mean, you will get stopped out. At that point if you buy at the top of wave 3. So let's talk about wave 4. Wave 4 is about profit taking. The early traders who have gotten into this move are taking profits. And then there are others who are going long, waiting for the wave 5. And what you have is sometimes you have whipsaw price action. So you have different corrective moves in a wave 4 that cause some traders to get in, some traders to get out, and it's easy to lose money or break even in a wave 4. And are you beginning to see how the market moves reflect the market psychology? So let's just repeat that. In a wave 3, the market is confident. Traders are confident about buying, going long. The fundamentals are supporting the move, and the corrections are very small. So the wave 3 is the time to even add to positions. It's the time to max out on your positions. If you're risking 1% of your capital, maybe you risk 3% of your capital during a wave 3. And in a wave 4, what is the personality? Well, it's just the corrective personality. It's the correcting the wave 3. Wave 5, the final advance, driven by greed. Bullish sentiment is still present, although waning. Smart money is out. So again, we see the market personalities in the market moves. Okay? The wave personalities, a function of how people are feeling, what the mood is. So what are traders doing in a wave 5? Well, if they weren't bullish in wave 3, they are bullish in wave 5 because the market keeps going up. And that can be a bit dangerous too, because the wave 5 is the final advance. It's the last struggle to create new high prices. And that's where you see momentum divergences. So you see momentum divergences between the top of the wave 3 and the top of the wave 5. You see fifth wave failures, which are your double tops. And you see your blow-offs where, sometimes the wave 5 goes above the trend line and then comes back within and then reverses. So this is point T, your termination point, and you need to learn how to target this wave 5 using Fibonacci tools, using channeling techniques, and try not to follow the crowd. I mean, it's easy to follow the crowd and to continue buying just because it's moving higher. But with trading, you need to be smart with your money and not buy after it's already moved up. You want to be buying before it moves up or during the move. Okay? So at this point, smart money is out and you don't want to be caught holding the bag. So it's best to figure out a way, and I'll teach you some skills on how to do it, to find the end of the trend and look for the correction, or look for a new move in the opposite direction. Here are some examples. This is the EURUSD hourly chart. It's a 5-wave impulsive sequence, and look at the wave 3. Okay? Look at these wave personalities as we just described them. Let's start with point 0. The wave 1 up is fairly sluggish. The wave 2 down retraces most of wave 1, so we almost double bottom there. The wave 3 is very impulsive. It's the greatest move for profits, and it's also an extended wave. The wave 4 correction, it's probably less than 38.2% of the wave 3 move higher, because it looks like the market is very bullish here. and then the wave 5 is the final move, and we reach point T. So this is the Euro-Aussie hourly chart. Again, this 5-wave sequence is found on every different time frame, every different currency pair that you're trading. This is a downtrend, our second example. And again, we see the wave 1 down, the wave 2 retracing most of wave 1. The wave 3 is a great move. The wave 4 is a 2-candle. This is a daily chart of the US dollar Swiss. So the wave 4 has 2 blue candles, meaning that it corrects for 2 days and then resumes the downtrend for the wave 5, which is a weak finish because you can see that the wave 5 double bottoms with the wave 3. Okay, and there's your termination point. So what is this, what is this telling us? That we really want to be in on a wave 3 move, and we want to learn the skills to determine the end of the trend. Okay, so there are 2 types of trades that we can take in the market. One is a trend following, where we want to get in on the trend, and the other is the end of the trend. Those are the, really the 2 solid trades that Elliott wave traders look to get in on. Now, there are sideways trades as well, because as you know, the market, it doesn't trend forever, and it does consolidate, and it does trade sideways. But if you're looking to trade, to buy and sell during sideways moves, then you have to look at bigger time frames that are just, trading sideways, maybe on the 4-hour or the daily even, for some pairs that are just trading sideways. And those will give you good trading opportunities when, you draw horizontal lines across tops and bottoms, and you see that we're reaching resistance. You can sell, and of course you have to look for your confirmations for the sales. And when we look for support, when we find support and you have a number of confirming points at that support level, you can look for other confirmations, like you can use oscillators. Oscillators are really good during sideways markets to get in on a buy. And frequently when you have these sideways markets on the bigger time frames, you have a good 200 to 300 pip move, inside that range. Okay, and we're not talking about that now when we're looking at a trend move. That's something else. And finally, here's a monthly chart of the euro. So again, at the bottom of the market, all the way on the left, the traders are less emotional and ambivalent, and the wave 2 comes down and it actually retraces most of the wave 1. The wave 3, again, a very powerful uptrend. Traders are confident. That's the psychology. That's the mood. Traders are confident. Traders, think the euro is going up. Wave 4 corrects the wave 3. And then the wave 5 is the final advance. And traders are driven by greed. And this is typical in the stock market, where traders just buy at the top of the market, and that's when you have all the press being very bullish, etc., and then it turns around. Okay, so this just illustrates that trader sentiment drives the markets during each wave. Finally, we're going to look at a case study. We're going to look at more 5-wave impulsive patterns, and we're going to look at the current EURUSD. So some more 5-wave impulsive patterns. We're going to take a look at some other markets other than the currencies. Here's the S&P. This is an example of a 1-hour uptrend. Okay, and this was taken this week. So you can see again, same characteristics of the market of the waves that we've described thus far. The wave 1 moves up, the wave 2 corrects wave 1. And then we have a nice advance for a wave 3. And by the way, notice the slope of the wave 3. It's steeper than that of the other waves. Typically, the wave 3 has the steepest slope. Okay, and typically, moving averages are pointed upwards. When you put moving averages on your charts, you can think of if you look at a clock face, the wave 3 and any impulsive wave for that matter in an uptrend should be pointing upwards and to the right between 12 and 2 o'clock on a clock face. And when you see that, that's a good time to buy on dips and to ride the trend. So wave 3 is strong, wave 3 is extended here, and then we have the wave 4 correction followed by the final wave 5 and an ABC correction. Okay, and where does the correction go? It goes to 50% of the prior 5 wave move up. So it corrects 50% of the entire move up. I think it's a good practice to use your Fibonacci tool to measure the prior sequence when looking to see how far the correction will take you. And that's what I do in my trading. Whenever we have a swing move, I will use my Fibonacci tool to measure that swing move to see what kind of correction I might expect. This next chart is a gold chart, and this is a daily gold chart, and you can see that we have a nice 5-wave sequence down, and inside, right, okay. So 5-wave sequence down on the daily, but let's put it into perspective, because if you look at the inside chart there, that's a weekly. Now we know that gold has been trending up for a long time, and this is a corrective sequence moving down. So again, you have to look at the bigger time frame to gain perspective. If you just looked at this daily chart, you would think that gold is going to collapse. But if you look at the weekly chart, you see that this is a correction within a broader uptrend. And it looks like this might be the close to the end of the corrective sequence, which will be followed by a move a move up. And if you look at the end of the wave 5 there, which is really the C wave, the C wave has 5 waves in it. You see a candlestick pattern, which is a bearish reversal pattern called a hammer, and then 2 subsequent blue candles on the gold daily chart. So I have a little note there, resumption of uptrend ? Okay, and the comment there is 5-wave move down in the context of a correction in the bigger time frame. So Elliott wave analysis applies to whatever you're trading. It's a great tool to use. It's great to use with whatever strategy you use to get into your positions.
Now it's time to look at a case study, the current EURUSD wave count. There are lots of Elliott wave counts out there. There are lots of analysts. So you want to understand how these analysts arrive at their wave counts. And you don't need to be a consummate Elliott wave counter to do this. You just need to understand the impulsive wave structure, the corrective wave structure, and know how to put it together. Like in this chart. If you look at this chart not knowing the theory, you see a lot of different wave labels, a lot of different colors, and it can be quite confusing. But if you understand the impulsive wave structure and the corrective wave structure, then this chart almost makes sense to you. But you might not even have time to label the waves yourself. But if you understand the theory and learn the wavy tunnel, you can let the setup speak for itself. You can let the wavy tunnel tell you a story about where the market is going and the specific trades you can take based on the setup. So let's have a look at the wavy tunnel and I'll show you what I mean. Now we have no wave counts and just the wavy tunnel, and this is telling me an amazing story. It's telling me where to enter short positions and where to enter long positions, and it's even giving me profit targets. And I see 5 potential trade setups on this chart. They're all here. They're all screaming out at me because I know how to tell the wavy tunnel story. And when you put this together with the wave counts, it tells an even greater story. Because then you have the wavy tunnel confirming the wave counts and the wave counts confirming the wavy tunnel trades. So it just works together. It's a fantastic combination of counting and setup and strategy. This concludes part 1 of the 2-part Elliott wave series, how Elliott wave analysis explains market movements. Stay tuned for video number 2 entitled 3 Trading Opportunities Identified by Elliott Waves, and more on the Wavy Tunnel.